This is an Uncovered Japan company research report on CELSYS, ticker 3663. CELSYS makes Clip Studio Paint, a digital illustration and comic creation app used by professionals and hobbyists around the world. The central question is whether its deeply embedded creative tool, fast-growing subscription base, and emerging creator platform justify a valuation that already assumes a great deal of future execution. The starting snapshot is unusually strong, but not cheap. CELSYS generated a 35.5% return on equity in fiscal 2025, while subscription annual recurring revenue reached 6.32 billion yen in June 2026. Against that, the shares traded on a forward PE of 27.8 times and price to book of 13.22 times in the report. Uncovered Japan scores the opportunity 13 out of 20. Excellent growth, but limited valuation margin for error. The product matters before the multiples do. Clip Studio Paint is built for drawing, comic production, panels, tones, perspective rulers, and multi-page work. CELSYS has effectively become a one-product company by design. Its creator support field, centered on the application, accounted for 85.8% of sales. That concentration creates risk, but it also means investors can track one global product franchise rather than a complicated collection of unrelated businesses. The key operating change is the move from one-time licenses toward subscriptions. Subscriptions represented 51.7% of sales and grew 34.2% year-on-year, while traditional buy-once tool sales still made up 32.4%. This is a deliberate conversion rather than an accidental mix shift. Recurring revenue improves visibility and lifetime value, but it also leaves CELSYS exposed if creators tire of subscription pricing or if competing tools take share. The financial history supports the quality argument. Revenue rose from 6.89 billion yen in fiscal 2021 to 9.47 billion yen in fiscal 2025, an 8.2% 5-year compound rate. Operating profit grew much faster, at a 21.1% compound rate, as the mix shifted toward subscriptions. There is an important accounting seam. Fiscal 2025 is the first year of non-consolidated reporting after group restructuring. Cash generation is another supporting pillar. Fiscal 2025 operating cash flow was 2.62 billion yen, with free cash flow of 1.72 billion yen. Management has used that cash in a buyback-heavy return policy alongside dividends. This helps explain both the strong return on equity and the unusually high price-to-book ratio. The equity base has been deliberately reduced. It is supportive while cash flow holds up, but it raises the importance of tracking future operating cash generation. CELSYS's moat is more than a popular app. First, artists build muscle memory, brush libraries, and years of project files into the workflow, creating real switching costs. Second, the platform had passed 13 million cumulative users by June 2026, adding community and marketplace effects. Third, 11-language localization took years to build. Finally, Wacom and Line Digital Frontier are strategic shareholders and distribution allies. The combined flywheel is valuable, but it is still centered on one product family. The operational KPI to watch is subscription ARR. It reached 6.32 billion yen in June 2026, up about 30% year-on-year, while the annual increase itself was the largest on record in the report. Monthly churn sits around 4.5 to 5% and has been stable to falling. Growing registrations and controlled churn make a compelling subscription flywheel, but the monthly disclosure is also a useful early warning system if either trend turns. The strategic upside is a transition from an excellent drawing tool into a broader creator platform. Creator platform revenue was only 14.2% of sales, so this is optionality rather than the current earnings engine. The research identifies a planned 2027 platform launch as a key milestone. Generative AI cuts both ways. It could enlarge the creator market or weaken willingness to pay for a specialist tool. This is the least proven part of the thesis. Valuation is where the story becomes less forgiving. The forward PE of 27.8 times was around the company's 5-year average of 29.3 times, but still rich compared with an approximate 20 times sector level cited in the report. The 13 times price-to-book ratio is not automatically a bubble. It partly reflects high returns and a buyback-reduced equity base. But investors need subscription momentum, margins, and platform execution to remain strong. Uncovered Japan's 3-year scenarios underline the debate. The author's estimates range from a 32% downside case to a 39% base case return and a 126% upside case. These are not price targets or recommendations. They show that the outcome rests on a few observable conditions: subscription growth, churn, operating margins, the platform's monetization, and the impact of AI on the creative software market. CELSYS is a rare Japanese small cap, a global category leader with a sticky product, rising recurring revenue, and strong returns. The counterweight is a full valuation and concentrated exposure to one product family. The most useful indicators are unusually visible in its disclosures: subscription ARR, churn, margins, and progress toward platform monetization. For the complete 5-part research series, including the financial history, governance, and valuation risks, continue with the free deep dive at Uncovered Japan. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.